Welcome to the Plan Your Federal Retirement podcast. I'm your co-host, Micah Shalansky, and with me is a great financial advisor, Christian Sakamoto. Christian, thanks for joining us, bud.
Hey, what's going on, Micah? Excited to be here again. How you doing?
We get to talk about an amazing topic today. So I'm always doing great talking about this topic, but I'm doing really good. Life is doing really well. Winter's starting to come to Alaska, and it's a beautiful time. How could I complain?
Good. Yeah, taxes, right? Taxes is what we'll be talking about today, and I'm excited too. We get a little bit giddy, do our little tax stance when we talk about it. There's a lot of moving pieces with taxes, and I know we talk about them a lot. We thought it would be good to talk about what this 10-year tax plan looks like and some of the things to be thinking about just in general when we're planning out the 10-year tax plan. So, Micah, where do you think we should start as we're diving into the taxes a little bit?
Boy, and I guess, Christian, why we speak about taxes, and I know our listeners know this so well, I know you know it so well, taxes is potentially one of the largest expenses you are going to have in retirement. This is why it warrants so much conversation about how do you lower that future expense, right? It's not going to be healthcare. Thank you, Jesus, right? It's probably not, because you have great health insurance as a retiring federal employee. Potentially long-term care, that's a different discussion on how that's going to be. Odds are for most of us listening, that's not going to be your largest expense, but taxes is the known, right? Those are the two things certain in life, death and taxes. And so we really got to talk about this bill. And it can be a surprising amount, and especially with this being an election year, depending on what we're going to see happen or not happen with taxes. So it's worth having a forward-facing look on this. So number one, you're at least not expected. At the very least, we get done with this conversation and you're not having some big shock on what taxes are going to be. And then number two, if I could really set an audacious goal out there, Christian, I know you share this as well, which is great. Now that you're not going to be surprised by taxes, how do you lower that overall tax bill so you get to keep more of your hard-earned money?
Yeah, how can we be proactive about some of the tax planning, right? Instead of just seeing that in the next few years, taxes are going up. Well, taxes are going up, nothing we can do. No, there's a lot that we can do and a lot that we can plan for. So that's a good thing to be talking about today.
Now, as we record this podcast, it is an election year, right? So on an election year, vote early, vote often on this podcast. Share this with a friend. Our goal, as you know, is to help another 1 million federal employees with their retirement, and we can only do that with your help. This is also an election year, and we have a couple of candidates out there that have a slightly different tax plans. As of this recording, VP Harris has not released her tax plan, so we have little hints at it. We don't actually know what it is. President Trump has talked about his tax plan. It is quasi-released, so we have a little bit more information on that side. And so we're going to give you a couple of different answers because we got to figure out which way the wind is blowing on this. But Christian, more importantly, what we tell clients is, politicians come and go, but we plan for the current law that we have today. Isn't that right?
Absolutely. And the current law that we have today, we've mentioned this quite a bit, is the Tax Cuts and Jobs Act that, as of right now, if no changes are made, sunsets at the end of 2025. So by 2026, this is what we've been sharing, is that under current tax law, there will be a change. Taxes will be higher. Now, as you mentioned, with VP Harris's tax plan, we don't know the details of that just all too yet. On Trump's side, we know a little bit more. But talk about, I guess, some of those changes, if we know a little bit, or what we think there.
Well, you know what? Let's do a little bit of a teaser if that's okay. Let's talk about changes in a little bit to make sure our listeners pay attention to the end of this. But let's talk about what does it take when we're looking at tax numbers and projections, right? Like what are the meat and potatoes that we got to kind of roll our sleeves up and kind of get into to figure out what these numbers are. And so, Christian, the way I like to start this, and I think it's the same with you, is it's all about income. It's all about how much money you have coming in every single month, right?
Right. So whether that's a W-2 or a 1099, what are those sources of income that's going to affect your tax situation? So I guess most commonly for the federal employees, that's going to be the wages that you earn, the W-2 income that you earn. For when you're retired, what else would that be? Well, that'd be your pension that's going to come in, any retirement account distributions that are from a pre-tax account like TSP or 401k or IRA. It could include investment gains, capital gains, interest, dividends, right? It'll include Social Security that's taxed. Up to 85% of Social Security is taxed. Not 85% of Social Security, that's not the rate, but up to 85% is taxed.
is included in your income. It could be a way to say it. So up to 85% of your Social Security is included in your income when the IRS goes to calculate your taxes.
That's correct. That's correct. Rental income is another one, right? If you're in Alaska, PFD, the pension fund dividend that comes in, other sources, right? Other small businesses, or you could be retired and have different wages. So there's lots of different things that can affect your taxes. And so I know a lot of our listeners are going to fit into one of these categories. We got to plan. What's that actually going to look like, not only today for 2024, but where will your source of income going to be in the next few years as well?
Yeah, that's a good point. Now, Christian, what about Roth accounts? If I have a Roth TSP, a Roth IRA, and I take money from that, how is that going to affect my taxable income?
Good news, no taxes on that Roth. You've paid them already. So yeah, it's a, you can't say that without a smile, right? Growing tax-free, taking it out tax-free. Roth's great.
Now, keep in mind with those Roths, the same with the TSP, the same with the IRA, any type of retirement account, there's always little catches and little rules you need to be aware of. So while Christian and I are going to say, yeah, you could take it out with this and this, we're assuming you understand some of those rules. So let's just pick the Roth for fun. There's a 5-year rule and 59 and a half before you can take money out without a 10% penalty and taxation. So, if you start pulling money out early, that could be a problem. Where people get in trouble is that they're like, hey, the TSP, as soon as I can retire, I can pull money out of there without a penalty. And we assume that is the same rule for all of my retirement accounts. And the answer is no. Each retirement account has slightly different rules associated with it. So on the most part, Christian, I agree with you 100%. Roths should be tax-free, but we have to use them correctly in order to make them tax-free. Is that a fair statement?
Yeah, absolutely. It's an important disclaimer there. Now, when we're talking specifically on Roths, Micah, when it comes to basis, is that also taxed? And do we have that 5-year rule with the money that we've put in and contributed to the Roth?
Oh, it's a great question. All right, so let's dive in a little bit deep this Roth. We're going to geek out for a minute, so bear with us, please, our listeners. All right, so on a distribution rule in a Roth IRA, the order of operations is, number one, whenever you pull money out, and this, you don't get a choice, this is just how it happens, your basis comes out first. Right? That's going to be the first thing that's going to be pulled out. So what does that mean? Well, if I'm putting in $5,000 a year for 10 years into my Roth IRA, okay, well, that's $50,000 that I have as a basis inside of that Roth IRA. At any point in time, at any age, I can reach in and I can pull out my basis with no taxes, no penalties, which is fabulous. I get a lot of flexibility. However, the growth that's where these rules come in. So if I put $50,000 in, and let's just say for discussion, my money grew to a total of $75,000. So I have $25,000 of growth in this account, just my hypothetical example. I can pull out that $50,000 without penalties. But the minute I start going into that growth, now I have my 5-year rule and 59 and a half that I have to meet before I can access that money without taxes or penalties.
Yeah. Thanks for clarifying that. It's helpful to know that 5-year rule, the 59 and a half, is really just on the growth there. Okay, what else when it comes to the taxes?
Yeah, so Christian, what we're first going to do, right, is the income. All of that stuff that you listed, right, we're going to break that out by year of what we think you're going to have coming in. Now, we're going to give you some action items. You don't got to go out and run a 10-year projection per se just for yourself right now, but definitely start looking at that income that you have coming in this year in 2024, and where is it coming? What source is it coming? And then how is it going to be taxed? And then Christian, after we get the income, we start looking at our deductions or our adjustments or potentially credits that you're available for. So everybody remembers itemized deductions. I say remembers, right? Because most people now under the TCJA, Tax Cuts and Job Act that went in 2017, most people are no longer filing itemized deductions. Most people are doing a standard deduction, which is really good, right? You didn't lose deductions. You actually got so much more, because what the rule says is that if you have at least X amount or less, you're going to get the higher of the standard deduction or you're itemized. So if you have $35,000 in charitable contributions, taxes paid, real estate property, state income taxes paid, plus mortgage interest, and it's like $35,000, great news, you're going to get the higher of that. You're going to get that as an itemized deduction. But if you have lower than that, and Christian, I'm blanking right now, what is the standard deduction? Do you have that by chance?
Yeah, so single in 2024, if you're under 65 or not blind, would be 14,600, and then 29,200 if you're married.
So 29,000 and change is your standard deduction, which is great. And so what we found out is most people were not itemizing, are barely qualified to itemize. Now they have a much more generous deduction under this tax cut. So that was a really good thing. So most people, Christian, that you and I run into are going to be doing a standard deduction. They're going to get that 29,000 and change. Sometimes what we see, though, is clients are a little bit more charitable minded, and that's where we might exceed that 29,000. Is that right?
That's right. That's right. So when it's specific to a few exceptions there's the over age 65. And then if you
Sure.
are blind, you can go and have an additional income. I'm looking at the brackets right now. So 1550 and then 1950 if you're married filing joint, if those additional deductions, if you're doing the standard. Now, if you're itemizing, like you had mentioned, and you're above roughly that 29,000, 30,000, then yes, we're able to take advantage of the itemized deductions. But as you mentioned, statistically, most people are just claiming that standard deduction.
So where this comes into tax planning is I have some clients that they give a decent amount, but maybe it's not over 30 grand a year. But maybe their property taxes are 10 because now that's what it's limited to, right? 10,000 the most you can deduct for property and state income taxes. But maybe they're given kind of, that 10,000, 15,000 a year in a charitable deduction. Well, now so that's 20, 25 grand a year, but they're still taking a standard deduction because it's higher. So Christian, sometimes what we do with clients is we double up on 1 year their charitable contributions. So instead of doing kind of 15,000 a year, and 1 year we do 30 grand, right? And then when we do 30 grand, we're able to add now that 10,000 of potentially real estate taxes that they paid. Now that's a $40,000 deduction. So just by changing the frequency of your charitable contributions, this is a good planning opportunity that we can kind of lower your taxes, and something we might have missed out on if we weren't being proactive with this.
That's great. And I know there's additional planning tools that are available to us, like a qualified charitable distribution that's available currently if you're over the age of 70 and a half. Works in a way where any pre-tax money that you have in an IRA, if you give that directly to a charity, that you wouldn't be paying taxes on it. So it's another great benefit. And then donor advised funds could be another good benefit. So maybe we talk a little bit about both of those, DAF and QCDs.
Yeah, I love QCDs, Christian. I know you do as well. We use them with a lot of our clients. And now again, the catch with this one is you got to be 70 and a half years young. Great news. If you're not there yet, you will be. So it's something to think about. And the way that this works is we can't do it with the TSP, unfortunately. No, that's not our rule. That's the TSP's rule. But it works great with an IRA. So we take a client that is charitable, they got enough to take care of them, but they want to make the world a little bit of a better place, which is just a beautiful thing. And so maybe they're giving 5, 10,000, whatever that dollar amount is, to charity. But Christians, we just talked about, they get no tax deduction for that because they're under the standard deduction. So once they be turned 70 and a half, now there's several steps you got to do to make this a success. We're kind of skipping over those to tell you what the nice part about this is. But what we'll do is we'll set up an account, set up for a QCD, qualified charitable distribution, and the clients will send money out of their IRA account directly to a charity. Now, what happens is they get a huge benefit. The income that gets sent directly to a charity, Christian, as you know, does not count as income. So if I'm pulling out money and it goes to Micah's bank account and then I send it to a charity, I have to pay taxes on that money. However, if I'm over 70 and a half and I send my money from my retirement account directly to a charity, several ways you got to make sure that gets done, right? But you send it directly to a charity, it doesn't go to my bank account. Now all of a sudden that income does not count. What does that mean? That doesn't increase it for IRMA, right? Which is that pesky thing, that income-related Medicare tax, which if your income's above a certain amount, your Medicare premium goes up. It doesn't increase it that. It keeps your tax base a little bit low. It's a way to get a great standard deduction and exclude some more income from taxation.
Yeah, and we do that quite a bit right now. And one of the things we've noticed is that required minimum distribution age has gone up over the years. Currently, it's between 73 and 75. They haven't, as of today, they haven't increased that QCD age. So it's still that 70 and a half. So it's a great planning tool as we're looking at deductions for that taxable income as we're planning what our tax situation is going to be. So if you're close to that and you are planning on giving to charities, one of the things you can do is, close to that age rather, is you could look at it and say, maybe I'll temporarily reduce some of my gifts and plan when I'm get to that 70 and a half, I kind of make up for some of the gifts that I've done or haven't done over the previous few years. We've seen that a few times. You can do a few planning tricks with those QCDs.
Now, one of the questions, Christian, we get often is say, hey, my kid's a charity, so do I write off all the expenses I'm giving to them? The answer is no, right? This is the IRS's definition of a charity, not your definition of a charity. So this does have to be an official charity set up to give money to. One other thing on that charitable fund, and again, we're big in making this world a better place, is those donor advised funds, DAF accounts. And Christian, we were talking kind of pre-gaming about these ones just a little bit. It's a really good tool. And basically what it allows, if I have an investment account, non-retirement account, if I have an investment account, let's say I bought Apple and Apple's gone up in value, and no, that's not a recommendation to go buy Apple, right? But if I bought a stock or whatever and it's increased in value and I sell that stock and give that money to charity, I have to pay taxes on the gains of that stock. But then when I give it to charity, I may or may not get a deduction, depending on if I've exceeded my standard deduction amount or not. So they created this really cool thing called, years and years ago, a donor advised fund. And basically what I do, and I use Schwab as an example because that's where I have my donor advised fund, is I have an appreciation inside of a stock or an investment, which is great, and I want to give money to charity. I will transfer that stock into the donor advised fund, and then I will sell that stock in the donor advised fund, and the donor advised fund then pays the charity. Well, what was the benefit of that little step that I took? Well, I moved it from being taxable to Micah, taxable to me. I put it in this donor advised fund where I got a tax deduction for whatever the value was of that. And then when the charity sells it, the donor advised fund sells it, there's no capital gains tax on that amount. And then that amount gets to go to charity. So again, it's knowing how to use these tools properly to make sure we're beating the IRS out of tens, if not thousands of dollars in taxes.
Agreed. And especially with the donor advised fund, you want to confirm that the charity or the organization you're giving to is on the list, right, of approved charities or 501c3s. So that's probably the homework you want to do before you just willy-nilly do that. But I agree, that's a really good option. What about some of these energy credits, like solar credits? What are your thoughts on them?
So one of the times, whenever we're going to make an investment, right, I always want to know, why are we doing this investment, right? That's the big question. What are we trying to solve for right here? And sometimes clients are going to come in, Christian, and say, hey, I want to move to solar because it's going to save so much money on my energy bill. That may or may not be true. I'm just going to speak from the Alaska perspective because that's kind of where I'm at. Solar's pretty expensive up here. And believe it or not, it gets dark in Alaska for, 6 months out of the year. So, that's an exaggeration, right? It gets pretty dark up here. So sometimes solar can be a good way to augment some cost, but not fully replace some cost. So the first thing I want to know is, why are we making this investment? Is it an investment? Or, hey, do I just want solar and I want to be off the grid? That's a different discussion than I want to return on my dollars, right? If you want to return on your dollars, we got to run some math and say, are you actually going to get a return? Maybe you will, maybe you won't. Let's look at the numbers. If this is hey, I want to spend this money as a home improvement and this is important to me, awesome. There's no problem with that. Then we spend the money as a home improvement. And Christian, that's where we have a lot of clients do. But it comes right now with an energy credit of around 30%. So if you spend $50,000 in solar, you get 30%, which is roughly a $15,000 tax credit, which is absolutely amazing because that credit counts at the tippy top of your tax bracket. So it's worth a lot of money percentage-wise. So one of the things, Christian, whenever we have a client, and you do a great job of this, I know, whenever we have a client that does these energy tax credits, we want to say, hey, do I want to trigger more income today and be able to use that credit to offset some of that tax liability? Is there some lucrative tax planning available to us? Now, this doesn't mean go spend $70,000 in solar to do a Roth conversion. That's not what we're saying. But if you happen to do solar or get an energy tax credit, we should be looking at tax Roth conversions, some type of triggering income today to help offset some of those future taxes.
Well, speaking of Roth conversions, we've been talking about charitable contributions, donor advised funds, the credits that we get. We talk about Roth conversions quite a bit as well. So as we're looking at our client's tax situation, where the taxes will be for them just this year and the following years, we have to think about where the tax laws might go. And we'll talk about that here in a second. But Roth conversions play into this because if we know or confident that our taxes that we're in today, the bracket that we're in today, will be lower than what they will be in the future, then we can do the opposite, where we're intentionally increasing our tax rate or how much income we're going to be paying taxes on by doing a Roth conversion knowing we're paying the taxes at a lower rate than what they will be when we spend that money in the future. So that's another point to make. And I know we talk about Roth conversions a lot, but it's just another good tool that we have when it comes to that tax planning that we have available to us.
Yeah, 100%. So looking at those things would be really important. So Christian, let's talk about, I know we're going a little long on this podcast, but it's taxes. How can we not go long and chat about it? So how do we start putting that together? What do clients start looking at doing in order to improve their future tax situation?
It's a great question. And I think the first place is going to be on cash flow, and not just net expenses and the net spending, but going back to the gross number and saying, what is our income that's coming in today between my income, my spouse's income, potentially any capital gains, dividends, all the things we've already talked about. Where do we think our income is going to be this year, next year, with any promotions, bonuses, job changes, life event changes, and kind of plan those out and begin to plan that out, not just this year, but in the future years as well.
And Christian, I love that, especially for our federal employees that are on salary, pretty consistent pay. It becomes an easy thing you can do. You can pull that LES, you can look at it. Now, a lot of them, every agency is a little different, but a lot of them, they're going to tell you your year-to-date taxable wages. And you could say, great, how many pay periods have I been paid? How many pay periods are left? And you can project out your taxable wages, which is so good. Now you don't have to think about your gross, what's deductible, et cetera. They put it right on that pay stub for you. Now, if they don't do that, you should go back to your agency and ask them to do that. But then you got to do a little bit more math to figure out what your taxable wages are. But Christian, I love that. Start with the money you have today, right? Get a good baseline. Then we start taking that out into the future and say, how will your income change? When are you going to turn on Social Security, right? Okay, now that added to your income. What's your pension going to be? What's your IRA distributions, right? But start with where you're at today. That's great advice.
And similarly, what effect that's going to have when you turn on that Social Security and when you go to a different tax bracket and maybe eventually Medicare bracket. Like, what are these effects going to be once we turn on these different sources of income that you have available? How that all ties in. I think that's the other thing. But then the last piece really is, how are we going to lower this? Or what are things that we can be doing today? Maybe we're intentionally, like I mentioned, biting the bullet and doing the conversion, knowing we're paying those taxes, but they're going to be lower in the future if we did the conversion on these dollars today. And then thinking about some of the other credits and deductions that we've already discussed, those are really where we have to head. Is not just, okay, this is helpful information, my taxes are going to be higher in the future, yippee, but what can we actually be doing about that today?
Now, it's good to look at the stick, right? It's good to look at the pain. Yeah. If I do nothing, what is the cost? Now, if our current tax laws expire, which that's currently the plan, is that they're going to expire in 2026. And normally our clients, which are mainly federal employees, are going to see a roughly 20% increase in their tax bill. Now, some people are going to look at the brackets and be like, Micah, it doesn't go up 20%. You must be smoking that crack in Alaska. Like, what's going on? This doesn't make sense. Well, when you look at it, a couple things are going to happen. Is number one, the percentage rate of taxes goes up and the brackets shrink. We have a progressive tax system, right? So that means the more money you make, you get bumped into the next tax bracket. Well, if the tax brackets are wide, that means it takes longer to get bumped into the next one. That means you're paying a lower tax before you get to the next one. If the brackets shrink and go on a diet, that means you accelerate through them quicker, and that means you're going to pay more in taxes. So really start looking at that stick and be like, ooh, if I do nothing, what is that cost going to be? For me, Christian, that's motivation to say I should do something now, right? If I look at it and say, hey, if I do nothing, I got to pay X amount more in taxes. But if I did this today, I'm paying a much lower amount in taxes. Okay, that delta's worth the pain today to make that change.
Yeah, absolutely. Not only the income brackets are getting squeezed and increasing, but then, as we know, the standard deduction that we're all familiar with is also supposed to go back to half of what it is adjusted for inflation. So what are those itemized deductions going to be? Are those even going to be close to the standard? So yeah, I can easily see an extra 20% easy for federal employees.
So big action items, right, is make sure you're looking at this today. This podcast is all about action and doing things right. And so making sure you're looking at this now. You got a couple months left. Make a good plan. We're being pretty proactive with a lot of our clients, triggering more income today in Roth conversions, paying that taxes. A lot of things to think about in a Roth conversion. I know we do it on other podcasts, kind of dive into that. So don't jump into this willy-nilly. Understand what you're doing, but really look at that and say, how much of that should you pull the trigger? I know personally in the last couple of years, I've done some very large Roth conversions. I'm going to do it again this year because I'm going to practice what I preach. I preach to clients, hey, pay the taxes today. Let's get some tax-free money. I'm going to put my money in that same category because I have the same concerns my retirees have, which is when taxes go up, how am I going to pay for that?
Agreed. And if you're a younger professional, like, and you're getting started in your 401k or your TSP, and you have the choice to do pre-tax versus Roth, maybe look at it and saying the same thing. Maybe instead of having to do those conversions later on, maybe we'll contribute to the Roth from the beginning as well. That's another thing to be considering.
All right, Christian, when you said if you're a younger professional, you paused. Were you about to say like me, implying that I wasn't the younger professional on this call?
Hey,
yes,
no,
that's what.
No, I thought about it for a second. I was like, am I even a younger professional anymore? I thought I crossed that bridge. So,
that's solid advice though, right? When are we going to use this money? Thinking about giving it tax-free. I absolutely love it. All right. Our listeners have some great action items to take away from this week. Making sure you're doing it. Be proactive in your retirement. Our goal is to help transform the lives of another 1 million federal employees with great information. So share this, get out there. Our YouTube is blowing up. Leave us comments. We now have a great number. You can call in and ask questions. It goes right to our voice recording. We listen to those, and now we're going to start doing podcasts based on those questions. We answer those questions on YouTube. So make sure you're calling in with your questions so we can get those answered. And if you're handling this stuff and you're like, hey, I want an extra set of eyes looking at this, then pick up the phone and give us a call. Sit down with one of us and have us go through this to make sure you have the best information. If it's not us, find someone else that you trust that's really good in this. We want to make sure your retirement is in safe hands. Christian, thank you so much for joining us. And until next time, happy planning.